are we supposed to get our bearings in what obviously is a constantly seesawing stock market, like I said at the top of the show? Now, do we stare at the action in the bonds, hoping it will somehow give us a glimpse of the future? Do we watch the White House like a hawk, deciphering every presidential tweet for clues about what's next in the trade war? Maybe we parse the state-published Chinese newspapers for hints as to whether the Communist Party is ready to make a deal? I don't know. How about we take a step back instead? How about we think this is maybe the kind of situation where you need to put your emotions in check, and nothing makes people more emotional than armchair political analysis, which I hate. We need to take a more objective, more empirical approach, something that's not going to devolve into a he said, she said. That's why tonight we're going off the charts with the help of legendary chartist Larry Williams. He's a technician who's been trading futures, commodities, and stocks for almost as long as I've been alive. I've said this before, but it is worth repeating. Williams is a near mythical figure in this industry. He's written almost a dozen books. He's got his own website. ireallytrade.com is what it's called, ireallytrade.com. And he's created a slew of technical indicators, many of which are named after him. For example, how many times have we used the Williams percentage R oscillator? That's him. And when Williams looks at the topsy-turvy market, he doesn't see a disaster waiting to happen. He doesn't see a need to reason to panic or sell out of this market. He's not waiting for the other shoe to drop. No, Williams says you should buy. Buy right now, right here. He thinks the averages have either already bottomed or they are about to bottom, at least for the moment. Yep, he's bullish. What a godsend. All right, what does that confidence come from? All right, for starters, take a look at this chart, which shows you a forecast based on the advanced decline line, a technical tool that measures the market's breadth. In plain English, the advanced decline line counts the net sum of advancing stocks minus declining stocks, the number of stocks that go up versus the number that go down on any given day. And it's cumulative. You can see it in black, okay? So when more names on the New York Stock Exchange go up than go down, the advanced decline line rises. Williams likes to rely on this tool because it's more stable with fewer wild gyrations than you see if you were only looking at the prices of the major averages. Based on the action in the advanced decline, it's the black line, okay? Williams sees a cycle of rallies and sell-offs that seem to repeat itself. This chart goes back a year. And you can see that the forecast, the red line, tends to move in tandem with the actual advanced decline indicator, although it's more exaggerated. Keep in mind, these cycles track the direction of a given move, but not its magnitude. They help predict when something will go up or down, just not by how much. You can see where we are, okay? When you project that cycle out, it suggests that the market should rally from here, right here, through the end of September, hopefully. Okay, with another big decline coming in October. But if this pattern holds true, Williams says you're going to want to buy again at the end of October, right here, okay, looking at another major run as we head into the end of the year. And that's just one bullish forecast out of many. Check out this chart of the CBOE Volatility Index. That's the VIX for short, going back to February. You know we love the VIX, also known as the fear gauge, because it's such a fabulous reflection of the overall level of panic in the stock market. As I've told you before, the VIX and the S&P 500 tend to move in opposite directions. When the S&P rises, the VIX falls, and when the S&P falls, the VIX rises. It's a pretty ironclad correlation, and it only breaks down when the market's about to make a major reversal. So Williams is on the hunt for times when traders are more fearful, more emotional, as measured by the VIX. He thinks there's a cycle involved, and you can see this cycle in red on the chart. Okay? So far this year, it's been a pretty good indicator. It captures the swings in the volatility index. If you can predict the action in the VIX, that's a terrific tool for calling tops and bottoms of the S&P 500. What happens when Williams projects that volatility cycle forward? Well, you get a big spike in the VIX right about now, okay? Right about now, which coincides with the recent market-wide turmoil. But then he sees a big fall-off in volatility, okay? Remember, when the VIX goes down, the stock market goes up. So this volatility cycle suggests it's time for the S&P to rally. Again, really good indicator. And likely through the end of September, that'd be a nice run. That's why Williams thinks it's highly unlikely stocks will go much lower. The volatility cycle has run its course, so now is the time to buy, right into Labor Day. Finally, there's the chart of the E-mini S&P 500 futures, which track very closely with the underlying index. When you look back at over the past 10 months, Williams sees a very dominant 80-day cycle that keeps repeating here. And when you project it forward, the red line again, you see we're poised for a potentially major rally. or at least an extended move higher. Remember, these cycles don't tell you how big the move will be. They just tell you when a rally or a decline is likely to take place. Put it all together, Williams has 3 different bullish forecasts here from the advanced decline, the volatility index, and the actual S&P 500 itself. They're all pointing to a market that's done going down and ready to rally, at least for the next month. The bottom line, the charts, as interpreted by the legendary Larry Williams, suggest that it's time to stop panicking, stop complaining, and start buying. He thinks the cycle of fear and negativity has finally run its course. So if the averages haven't bottomed already, they're going to bottom very soon. And that's why Williams says you need to be a buyer here, just as long as you're ready to ring the register on part of your position a month from now, when these cycles may turn against you. My view, I think you need to take his bullish perspective seriously in this environment where so many professionals seem committed to mindlessly sowing fear. And I never like to bet against Larry Williams. Let's go to Mark in Pennsylvania. Mark.
Booyah, Jim.
Booyah,
With the
Mark.
recent volatility in the market, is Wheaton Metals, WPM, a good investment, given they have exposure to gold and silver?
I like, there's 2 I like. I like Barrick, and I like Agnico, and I'm not going to deviate. Those are the 2 that I want. Let's go to Rick in Illinois, please. Rick.
Hi, Jim. I've been a longtime member of Action Alerts Plus.
Oh, great.
And really appreciate your guidance in the volatile markets we're in.
Thank you.
Going along with your recent theme to try and find good quality-paying dividend companies, a while back you had the CEO of Apple Hospitality REIT on your show. I recently listened to their conference call and was impressed with the fact that their portfolio consists of over 200 U.S.-based Marriott and Hilton hotels. And in addition to that, they pay a dividend monthly of almost 7%. So with gas prices and interest rates relatively low and consumer confidence high, it seems like hospitality companies should do well in this type of environment.
I have to say, I think that's a good idea. We did have them on. I didn't like it. I'm going to look. Ben Stoddard and I have been working on trying to find out which dividends are safe, which returns could be safe. And I've got to tell you, I've got to do more work. But I think that this is a very compelling idea if it checks out. 7.7% yield is a pretty nice yield. All right, our chartist says it's time to stop panicking and start buying. And I'm not wanting to go against legendary Larry Williams. There's much more Mad Money ahead. Instead, including my exclusive with Nestle, is the company in the sweet spot when it comes to the packaged food space. I'm going to talk to the CEO. Then how much emotion is in this market? Take one look at my Twitter account to find out. I'll tell you why it's time to check the feelings at the door. And all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.